The broadcast is now starting. All attendees are in listen-only mode.
All right, everyone, good afternoon. It's Bobby Rains here for our Investors Observer Members Only Workshop. It's been a while since we've done one of these, but we are back and ready to go now. I hope everyone enjoyed their holidays and is ready to start 2019. All right, so we'll glance at the agenda here. We're going to do a market update. We don't have a whole lot new going on in Investors Observer right now. And then, yeah, I do have a couple of questions I got ahead of time. You can send those in as always, but also any questions you have today in the moment, just put them in the question box and we will try to get to as many of those as we can. And yeah, I'm happy to prepare slides for questions submitted ahead of time. Just mention workshop. All right, so let's get into that market update. So this is a fun chart. It is 20 years worth of 1 month candles. I kind of underlined the sort of the low ends of the channel from the pre-2008 rally, which you can see we sort of broke through, earlier this year. Both times we set new highs in the S&P 500 this year, we broke through there. But also we've been, sort of in this uptrend, to use this lower line here, since the lows in 2009, and we are, sort of back in that channel. I've done this chart sort of previously with another line in here. I think that was in a blog post. Where we clearly broke out. We're now sort of, I think, healthier from a technical perspective in terms of being back in this channel. I think we did get a little extended up here. In valuation terms, it's hard to say that, obviously valuations are lower now than they were, but yeah, what's the right valuation is a question that doesn't really have an answer. But I did think it was interesting, and this is also an example of when people talk about, and this isn't really an output gap. When people talk about an output gap, they talk about if you're on one trend and you have a period of sustained losses and you get on another trend, that's essentially what an output gap looks like, is that same basic idea. All right, so then I wanted to zoom in here a little bit, and what I did was I left the channel lines. Those are still the solid lines here, but I zoomed in. So this is 4 years of 1 week candles. This goes from 2015 through the last trading day of 2018. And you can see that starting back in 2016, around the election, we got a much sort of steeper trajectory going up, which is great, right? Like everybody likes stocks to go up fast, but that tends to be not so sustainable. So I can go back here a little bit, right? Like right here, you can see the line just gets a lot steeper than it was previously. And there's no, look at how few red months there were in here. Yeah, it just goes up and up and up. And so, yeah, that tends to be unsustainable. And then, yeah, we had that period of volatility in January and February, and then came back and set new highs again, and then fell off a cliff at the start of October. So yeah, that's that. And then, yeah, I wanted to kind of capture the breakdown. So here's the top of the previous channel, right, the long-term trend, and then here is that uptrend line from before, and you can see we've got back above it a couple of times, and then really broke down. And then I just tried to connect some of the lows here and the highs here, and you can see we're kind of in the middle of things here. I don't know. Yeah, I would like to hope we won't go back and retest these lows. What you'd like to see is the next high to be higher outside of above this line. Right, that's a good sign of a recovery when you're making lower lows and also lower highs. That's not a particularly good sign. But yeah, we'll see. The rally at the end of last year was nice. It's hard to put a lot of stock into anything that happens in the last week of the year because there's typically very little going on. Volumes tend to be pretty low. And so you can get some big moves like that that ultimately have no follow through in either direction. So we'll see how it shakes out. I'd like to hope that the bottom is in here, but I'm not entirely convinced until we see some sustained movement back to the upside. And then I did put together another one. I started here with a 3-year chart because that's how far back you have to go to find some of these support and resistance levels. But if I did that, you couldn't really see how that played into what's been going on recently. So I had to kind of zoom in. But if you pull up a 3-year chart, you can find this stuff. And then this is just 6 months. So 2,400 was a decent level of, should have been a decent level of support on the way down. The market kind of took a pause there on the way up. You can see we broke below it on Christmas Eve and then came roaring back with that big rally on the 26th. 24.8 on the S&P is another level where we had some resistance before, and then 25.8 and 2600 had both been levels that had served as resistance and then as support in previous pullbacks. So it looks like we're probably going to close. I'm not sure exactly where we're going to be. Somewhere on either side of, probably this line here. Today, my guess is probably right close to it, maybe a few points above. And then, when we get back to, if we get back to 2,600 anytime soon, I expect that to be a little of a battle to sort of break through. And then if we end up going back down, 2,400 is going to be a big number. And then I don't remember the exact point for these lows, but that would be another significant point to watch. All right, and I didn't do the charts for the other indices just because they're relatively similar. The numbers for support and resistance would be different, but I don't know that those are more meaningful than the S&P. I tend to like the S&P because it's broader and less exposed to big moves in individual stocks or trends in one particular sector or industry. So what else we have going on? Trade is still, I think, a big driver of the market. There haven't been any real new developments since, we had the Fed meeting in December, but on the trade front, there haven't been any real new developments since, I guess it was December the 1st. And then a few days later when, the US and China put a 90-day pause on new tariffs. We're a third of the way through that pause. I haven't really heard of any new developments. I saw a headline today there may be a U.S. delegation going to China for some negotiations. That has happened previously and nothing came out of it, so we'll see if something is different this time. But that seems to me to still be the biggest overhang over things. The softening economic numbers that came out of China this morning, I think, are certainly related to trade. People are ordering fewer things in anticipation of prices being higher, potentially, under a different tariff regime. And then the Federal Reserve and interest rates are still a big deal. I do expect a pause going into 2019, but I also expect a lot more noise. So the Open Markets Committee meets every 6 weeks. Previously, they had a press conference after every other meeting. And for pretty much the entire recovery cycle, either under the Bernanke or Yellen or Powell, there was never a change to interest rate policy that didn't come at a meeting that had a press release. And so that led to the treating of some meetings as live meetings where a thing could happen, and every other meeting was essentially considered to not be a live meeting where pretty much everybody just read the statement to try to figure out what was going to happen at the next meeting. There was nobody expected any sort of change to interest rate policy at the meetings that didn't have a press conference. So starting this year, every meeting has a press conference. So that will get you certainly a lot more noise. I don't know that there will be actually different policy coming from that. but we'll see how that works out. Like I said, I expect the Fed to sort of pause. I don't know that the data really calls for another rate hike. I don't think the Fed thinks the data calls for another rate hike if you look at the dots from the December meeting. But we'll see how. Yeah, we'll see what happens there. I think they were calling for, I think, 1 or 2 hikes in 2019 as of the last meeting. So we'll see if those develop. Obviously, I think 2018 was the first year, maybe since the bottom in 2009, where they actually made the number of rate hikes they were predicting before the start of the year. So those projections can and do change pretty much every time out. And then the other things we have going on are politics in Europe. Brexit is scheduled to happen on, I think, March the 28th, and there's still no deal there. We'll see what happens there. It doesn't seem like anybody really wants to make a deal, and it doesn't seem like anybody really wants to go to Brexit with no deal. So, yeah, that should be exciting, let's call it. And then, yeah, the situation in France is interesting. It seems to have calmed down some, but, parliamentary systems, they can have significant changes in government a lot more frequently than we have in our system, and how exactly that will play into things, including Brexit, is going to be interesting as well. All right, so that's it for the market update piece. I don't really have anything else. If anybody has any questions, I'd be glad to tell you what I think, but we did actually get some questions ahead of time from Bob, so I'm going to go through those, and then then the rest of the time will be Q&A from you, the subscriber. All right, so Bob sent in a number of questions, and I'll just take them one by one here. I tried to put some brief ideas about answers here in italics, but I do have a little bit more to say, so you'll get the full thing here over the webcast. All right, so the first question was, do you ever use inverse funds for credit spreads, covered calls, or diagonals? You can use those. Some number of them are available in TIG. The thing is, with the exception of covered calls, I'm not sure why you wouldn't use a bearish strategy. The liquidity in the inverse, especially if you're talking about like S&P 500 funds or something like that, the liquidity in the inverse S&P 500 is going to be significantly less than the regular S&P 500. And so if you're interested in doing a spread, you probably get a better price for the same trade. Doing a bearish strategy on the long version of the ETF as opposed to using the inverse, but you obviously can't do that with a covered call. So that may be the exception there. But I also, generally I don't like most of the things that have inverse funds, our indexes or broader things like that, and I don't love making a bet for a super long time on that's bearish on the overall market, just because bull markets tend to be relatively long and bear markets tend to be relatively short. Kind of prefer to sort of sit on the sidelines a little bit when everything is going down, just because things can snap back a little bit and then you get whipsawed. And I don't care for that much. Certainly your mileage may vary. If you have a trade you like and you're comfortable with it, go for it. But I would take a look at just doing a bearish strategy in terms of prices and liquidity, as opposed to doing the inverse. I didn't actually look, but my experience has generally been that, especially options on the inverse funds, just trade less, and so the spreads are wider, and it's harder to get a decent price there. And then he said, for diagonals, I generally get out of a position if I'm down 10% the gross value. Are there any other defenses? I don't really like a hard rules-based approach. It works sometimes, but there are some times when the bottom is 10 plus 1. And so in that case, you took roughly the largest loss available. I prefer to try to be generally more pragmatic about things. Obviously, if you look at a couple of portfolio trades, in retrospect, I wish I had gotten out down 10%. But there have been plenty of other trades over the years where I've been down 10% and they've come back. Depending on the strategies you're using, if you're using a wider diagonal, we have some $20 and $30 and $40 diagonals that we've done. 10% might be okay. If it's only a $5 spread, 10% might be pretty tight, just in terms of not giving the stock very much room to wiggle. Other defenses, it hasn't worked out super well for us, just because of the way the market has, but we are looking at doing more collars, sort of on open positions anyway, to carry things through earnings. Obviously, if you have a long and a short at the same time, you're not really making anything off of the short part of the collar, but you're not losing anything anyway. So, if the stock takes a big dive and you can get out of a put position, now all of a sudden you just own the stock at basically a lower cost basis without having a big loss. So that's the thing we're working on in terms of defense. I don't like collars all the time just because I feel like in a normal market it's just a drag on performance, but in this kind of market it may be a thing we look at more often, especially around known news events like earnings and things like that. And then do we have a general rule about being in the market relative to VIX value? And not really. High VIX tends to be relatively short-lived. We typically open, just historically, we've opened fewer positions when the VIX is super high. I'm not sure why that says short, it should say high. But yeah, because it measures uncertainty. And so with our style of trading, we prefer to have some directional bias. We've made some bearish trades that worked out in 2018, and we made a lot of bullish trades that worked out, and we obviously toward the end of the year had some bullish trades that didn't work out. But yeah, I think we tend to open fewer trades when the VIX is high, but I don't think there's a magical VIX number where we would just close everything and pack it in. So yeah, being in the market is I can interpret that a number of ways. I tend to put out less positions when uncertainty is high just because I like to have some idea of the bet I'm making, right? We're not making a lot of, if we were selling straddles or strangles or something, maybe you would look at that. But, if we're making a directional bet here in most cases. And so a high VIX, as a measure of uncertainty, I don't really care for opening trades in those cases. But yeah, I'm not going to close a position that I like otherwise just because the VIX gets high. Anyway, yeah, so those are the questions that Bob sent in. Thanks to him for that. And yeah, if anybody else has questions, now is the time. We're here until 5 or until we run out of questions. Either way, and we can look at the website. We can talk about the market, individual stocks, positions, kind of whatever else. I haven't read all the yearly previews, but lots of opinion seems to generally be that we're past the peak for growth, which typically means you pass the peak for stock prices also. Whether that means we go down further from here is a totally different question. But that does seem to sort of be the consensus. None of that implies a recession necessarily. Right? Recession means actual contraction for 2 quarters, which is different from growth not being as fast as it was. And so, yeah, those are different things. And I think people, a lot of people in the media seem to not make those things clear necessarily. I think it's assumed, but a lot of times it can be confusing. So I do like to point that out. And there certainly is there's a lot more consensus about earnings growth being past a near-term peak than there is about any sort of recession call in what I've read so far. And then, yeah, the other thing is that the government shutdown is still happening. It's day 11 or 12 or whatever, and I don't know if that includes the holidays and weekends. It is relatively contained, generally areas with high federal employment. I originated in Northern Virginia, so I know some number of people there aren't working. It turns out most of the federal employees typically will end up getting, the bill to reopen the government will typically cut those people some sort of a make good check. Obviously, that doesn't help with rent this month, but if you're a landlord in areas with high federal employment, you probably have dealt with this before. The people it does impact tend to be contractors. Privatization has meant that a lot of janitorial staff, food service staff, and things like that, things like the various museums are no longer federal employees. They're contractors now, so those people just won't get paid, which is hard for them. And so that has the potential to spread places. And I know, I have a friend who is a bond reporter. And since the SEC is closed, they're not accepting new filings. So bond issuance goes down. So people like that can't work because there's nothing for them to do. And so that's those are the places where it starts to show up. They've done a different thing this year where in the past, shutdowns have been mocked for, the government had to send people out to do work to close the national parks. They could have just left them open. And so they didn't do that this time, but what's happening now is there's nobody to take out the trash, or frequently there's no sewage, so the sewage gets pumped from those places, and nobody's doing that, so things are getting destroyed and trashed, which isn't great, obviously. So we'll see how long the shutdown lasts. Trump said, I guess yesterday or this morning, he was ready to make a deal, and he's supposed to have some sort of meeting today. As of when this started, I hadn't heard anything from that meeting. So we'll see where that goes. I haven't really seen anybody making a lot of concessions, but I also don't expect this to drag on for months. So yeah, we'll see how it goes. As of now, I don't think the shutdown has been long enough to cause any real damage to the broader economy. Obviously, it's really hard for the people who aren't working and don't know when they're going to be getting a check again. But in terms of the broader economy, I don't think it's really done a whole lot at this length. All right, so here's a question from Fred. He wants to add a spread to the portfolio to keep an eye on. So, Fred, we don't currently have a tool for you to add your own trades to the portfolio. The trades that are in the portfolio are picked and managed by our analysts for you to follow along. And we are, looking for new trades pretty much every day. We haven't seen anything we really liked recently, but we are working on that. We hope to have something out soon. As for being able to track your own spreads, that is a thing we're working on. I don't have a timetable yet. Optimistically, I'd like to say first quarter, but that's as tight a tighter range as I can really give out right now. But that is coming at some point this year, and definitely in the first half of the year. Hopefully in the first quarter. That will track. So far, it's every strategy that I've been able to come up with. So the ones that we support in terms of what we have in our other products, and then other strategies work in that technology as well. So we'll have that coming out fairly soon. Other questions? So Fred, I'm not sure exactly which trades you mean. Oh, pull the website up here. There we go. So if you're talking about trades that show up as picked for you in Trade Idea Generator, we do not track those. You'll be able to add those to the tracker that we're developing, but currently we pick our analysts pick and manage strategies in the covered calls, diagonal spreads portfolio. We don't have any open, but also the vertical spreads portfolio. Our analysts pick those and manage them, and we send out notifications. Anytime there's anything that you need to do. So by notification, email, text, and push alerts, which is a little window that shows up usually in this area of your screen. And we'll pick those and do that. And yeah, to answer another question, we send out notifications for new trades and then any action that you need to take along the way. And then, if a trade closes, if you need to take an action to close a trade, we'll send out a notification for it. For covered calls, typically we just let the call be assigned, and in those cases we don't. And then, yeah, the performance of the portfolio has been poor in the fourth quarter. I don't have another way to say it. I'm relatively optimistic about Garmin and Nav in terms of being able to do better than the current position. I hope to do better on Square and Play than where we are currently. Square, we're probably going to close in the next. Obviously we'll close it before the 18th. That's going to be a big loss. I'm not particularly happy about that. And then. Excuse me. Yeah, Play is another one that we're kind of looking for the exit and finding a way to finding the least bad option on those two. But yeah, Garmin certainly, and to some extent also Nav. I think we should be able to do okay there. In terms of getting back closer to break even, or ideally even into the back into the green. All right, so Alan says, what is the best way to set a stop loss on a bull put vertical spread to limit losses? This is a question we get a lot. So the way to manage risk, I think, especially with those spreads, is by position size. So number of contracts, right? I mean, if you do one contract of a $5 spread, that's $500. Obviously, if it's a $2 or $3 spread, it's $200 or $300. And so doing fewer contracts is, I think, really the way to limit losses there, as opposed to trying to set a stop loss. And the reason for that is, as the time value runs off of either side of the option and the stock price changes, you could set a contingent order to get out with the stock at a certain price, but your loss on that order is going to vary depending on how much time is left to expiration. And then you could set an order to get out for a certain, if the price reaches a certain debit, probably. But that's going to get you out at a different stock price depending on how much time is left to expiration. So typically what we do is, when it looks more likely that the stock is going to be below the price of the sold put than above it, start looking for a chance to get out at that point. In terms of just a set it and forget it kind of thing, we don't really have that. I don't think you can really do that with vertical spreads. But I would say that, yeah, if you're looking to limit losses on any particular position, the best way to do that, especially in the vertical spreads, is position size, and not having some sort of rule about close it if the stock falls by a certain percent or something like that. I don't think that really works very well. I think it's probably better to only put a limited number of dollars at risk. And you make, unlike some of the other strategies, you make a very high percentage return in terms of risk and reward on the vertical spreads. And so, if it's risk 500 to get 100, that kind of thing tends to be, you can work out better ahead of commissions than you can with maybe some other things where, you had a much lower percent return that you were targeting. So yeah, we have another question about plans to add butterflies. We have iron condors available in the trade idea generator, and butterflies will work in our new portfolio tracking system. We don't currently have any plans to add them in any other ways, but certainly, we could consider adding different strategies to TIG in the future. And butterflies would probably be on the list there. Yeah, there seems to be, certainly right now at least, there's less demand for those sort of neutral strategies, and there are some more directional plays. But yeah, certainly as we try to expand our offerings in the trade idea generator, that is a thing that we would look at. All right, I don't see a lot of additional questions coming in, so I'm going to get ready to sign off. If you have more questions, go ahead and put them in the box. But yeah, thank you all for coming. We will be having our next workshop we can try to get back to our regular schedule here of 3 weeks, which puts us at January the 23rd. So be on the lookout for that. We'll post a recording of this presentation and a link to the slides on our blog probably tomorrow, and we'll send out an email when that happens as well. And then, yeah, be on the lookout for trades and things like that as we try to get back into the swing of things. Hopefully, the market will cooperate with us, and we'll be able to get some things done there. Yeah, okay. Thank you all for coming, and have a good rest of your day.